This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Somak Chattopadhyay and Anthony Santaro from Armory Square Ventures. Somak is the founder and managing partner at Armory Square Ventures, and Anthony is a senior associate at the Armory Square Ventures as well. Armory Square Ventures is a venture capital firm based in upstate New York and New York City. They provide the first round of institutional capital for companies targeting the largest industry across New York State and select emerging cities across the Northeast. Anthony, Somak, thank you for joining us.
Thank you for having us.
Very happy to be here.
Great. So where are you guys calling from today?
We're calling in from our Skinny Atlas, New York office in the Finger Lakes region, about 30 minutes away from Syracuse.
Well, that's great. You must be having some nice weather this time of year. It's hot everywhere else. How is it there?
So it's beautiful. Right now, it's like, I think in 70 degrees. We're actually overlooking, I know this is an audio podcast, but for your benefit, Hall, I'll show you, a view of what our office looks out onto. We're overlooking a beautiful lake and a dock and a bunch of these beautiful boathouses. This is a really, really beautiful scenic town that was founded by entrepreneurs in the late 1800s, and it was always a summer estate for people when they needed to escape the heat. And so we're very blessed to live in this part of the world and take full advantage of it.
Great. Well, let's talk about your backgrounds before joining Armory Square. Someone, can you go first and tell us more about your background and what you did before this?
Sure thing, Hal. So my background. So I've been in the technology industry since 1999. After I left Boston, late 90s, I had studied engineering at MIT. I, like many people at that era, was excited about the technology industry, and those were during the Web 1.0 days. So I did a short stint initially in investment banking at Broadview, which was a tech M&A shop, but moved quickly to the startup side. Initially, a company called Shopping.com, one of the first comparison shopping engines that went public and was acquired by eBay. I ran product and business development at a very young age. I didn't know what I was doing, so I made a lot of mistakes and learned a lot along the way. But it had a great outcome, and I had some great mentors, and was good timing as well. Moved over to a digital health company called MedTower, which was a knowledge expert for the healthcare sector, similar to GLG Group, Garrison Learman Group. That company was acquired. And then I moved after business school. I went to the venture side in 2005, initially at Edison Partners, which has been around since the 1980s, leading B2B software investments, especially in secondary markets that are ignored by many of the people in Silicon Valley. And then moved over to Tribeca Venture Partners, where I was a partner until 2013. I was then recruited by a group of institutional investors and family offices to launch Armory Square Ventures to focus on early stage capital in these regions. So that's my story in a nutshell.
Well, thank you for that. And Anthony, tell us about your background.
Yeah, so I'm originally from Syracuse, New York, so an upstate New York native. Went to school at Johns Hopkins down in Baltimore and studied economics, and started my career off at Wells Fargo's investment bank in New York City, specifically in their corporate finance and strategic transaction advisory group. So it was a great way to work with companies across different industries, public, private, on both corporate finance issues, as well as strategic transactions such as an IPO or a merger and acquisition. Was there for the 2-year analyst program and then switched to a private equity firm, also located in Midtown Manhattan. That was a special situations group. Did every type of financing from leveraged buyouts to distressed real estate transactions. But the one area that I was most drawn to was earlier stage venture capital investing, and was able to spend a small part of my time there, but not as much as I wanted to. And at that time, I was also looking to make my way back home from New York, and was very fortunate to join Armory Square Ventures, which was a perfect intersection of all my interests then.
Great. Thank you for that. And so my first question is, what excites you right now? Somak, let's start with you.
In terms of what excites me, and I also want this thing to be mentioned, we're so lucky to have Anthony on our team, and that we have a team that's growing and expanding as well. We can talk more about that if we have time. But in terms of what excites me now, we've always believed that, there are many industries that have massive total addressable markets that have often basically been left behind by the software tech sector. And these are generally based in regions that are not in the large metro area. So when I talk about industry verticals, those include industries like manufacturing, construction, trucking. These are just examples of huge industries that are in the early stages of embracing software innovation. Some of these businesses could benefit from SaaS platforms addressing inefficiencies in those markets. Other people are excited about liquidity of marketplaces that connect buyers and sellers in those markets. And so really over the last few years, the pandemic was clearly an accelerant for this. There was a lot of talent migration to these regions. A lot of these people who come from the tech sector or other industries saw these huge opportunities and are founding companies to address these larger industries. And those are things that we find super exciting.
Great. And Anthony, how about you?
Yeah, Hall, we were talking a little bit about it before the call started, but what's really been exciting over the last, call it 6 months or so, are we've been seeing a lot more companies, but also a lot of really great quality companies that in the past, especially in more of the primary markets like in New York City, it was just a little bit harder to find, or they're such an accelerated timeline. And so what we've been seeing lately is these really strong quality founders that have been much more approachable and have been allowing us to really do the diligence that we like to do and finding exciting opportunities in a lot of the sectors that Somak was talking about earlier that are still on the cusp of this digitization.
Great. Well, my first question is, what's your advice for people investing in startups? You guys see a lot of different startups out there. What's your advice for the investors and what they should do before they write that check? Anthony, let's start with you.
Sure. So something that I think I would always advise is really sticking to a core set of principles, whether that be your investment thesis or the style of investing that you do. So for us, we're really focused on that seed Series A stage of investing, particularly in B2B SaaS and marketplace companies. And so something that's kind of always been our North Star is to stick true to our knitting. And so it's finding companies that are part of that business model, are part of these industries that we've had success and experience with in the past. And so I would recommend that to all investors, is to really stick with what you know in the areas that you've been able to prove out, rather than venturing too far away from your stated thesis.
And Somak, what's your take?
I agree with all those things Anthony said, and I would add just one more heuristic that we use at Armory Square Ventures. I think we are always, we've spent a lot of time, some of us have been doing this for decades, looking at opportunities to back world-class entrepreneurs in SaaS and marketplace technology businesses and in secondary markets. I think, though, that once you get comfortable with the large market opportunity, market's extremely important, but management teams are also very important. So the market type of stuff, the market sizing and the product market fit is something that as investors, you get better and better doing as you build a larger network to be able to help you figure out, is this really a must-have versus nice to have? The other part, though, that's extremely important for investors, it's much more of the softer part of investing, the soft skills of investing, which is, do you get excited about that entrepreneur? When an entrepreneur pitches us, we see thousands of entrepreneurs, as you know, like many early stage funds that have fresh pools of capital and have track records. But the issue is that when I started in the VC, I was like a kid in a candy store. Everything looked very exciting. What's really important is to figure out and hone your radar and say, is this a CEO that I get so excited about that I would quit my job as a VC, which I think is one of the most exciting jobs in the world? Do I get energized when this person calls me on a Saturday night? Do I want to spend 2 or 3 days getting stuck in airports and jamming on business, or I'm like, get me the hell away from this entrepreneur? If it's something where you really truly are energized and you feel like you want to quit your job, to us, that's a pretty strong indication that this is an investment and it's going to be the start of a great 5-10-year partnership.
Great. And then on the other side of that table, what's your advice for people running startups? What do you tell that founder to do before they go out to raise funding? Somak, what's your take?
So I think there's a few things. One, first of all, you need to really make sure you do some soul searching to figure out, is venture capital really the right product for you? There's numerous investors who've blogged or spoken about the fact that venture capital is really a product that is a phenomenal product for the right type of opportunity. But if you think you'd be happy building a business to tens of millions of dollars and you would potentially consider cashing out at a $50-100 million exit, venture capital is not the best product for that. And once you get on the venture capital flywheel, you can never really get off. So that's one thing that I think is worth talking to people who are entrepreneurs. The other thing thing is that just, I think it's really, really important, whether you're an entrepreneur or investor or anyone in business, or frankly, to your spouse, you should have the same philosophy, which is when you say you're going to do something, do it. Meet and exceed expectations. When you do that as a board member, as an investor, or if you do that as a founder, when you raise money, capital from someone, you develop a great reputation, a great rapport, you create positive vibes. And when it comes time for that next round, you can hopefully close that pretty easily. That's something that a lot of really, really smart founders and investors, I feel, don't do. They get overwhelmed. They get pulled in many different directions, and time management, prioritization, and follow through becomes challenging.
That's good insight. And Anthony, what's your take?
Yeah, all great points by Somak. Something else I would add, just kind of coming from the financial world, I'm always really interested to see what the use of funds are for a round. And so some advice that I would have on that front are two different areas. One, I would always recommend, as a firm, we were always saying at a bare minimum with a new funding round, you'd want to have at least 18 months of runway. And really, we've been saying that we'd like to ideally see a more closer to 2 years, 24 months. And so that's to allow the company to have enough time to raise the money, but then also to efficiently put it to use, which usually takes a couple months, and then to scale up from there, and then budgeting a little bit more time than might originally be thought for that next follow-on round. So just to really give them an ample runway in order to allow them to execute and to hit all of their goals, which is kind of the second point. So something that we always look for when we're underwriting a decision is what goals do they want to achieve before catalyzing that next fundraising round. And so that would be something else. And I guess lends itself to what Somak was saying, following through. So whether it's on an ARR goal or doing team hires, making sure that they have the runway and the capabilities in order to achieve that.
Well, that's a good point. Well, let's talk about the state of venture investing today. It's been changing a lot in the past and continues to do so. But how do you see the industry evolving from here? Somak, what do you think it's going to be?
Yeah, I mean, I feel this industry, I've been doing this now for nearly 20 years, and I feel like what we see happening in the venture industry happens every few business cycles, right? There's a period of time where venture capital suddenly becomes the hot industry. It's a high beta industry. What that means, of course, for those who don't know the phrase, means that when the public markets do well, venture capital does extremely well. Right. And so what we see, and we saw a lot of this happen in the last few years with, zero interest rates environment, suddenly venture capital became the most attractive asset class ever. Right. And then everybody and their mother started, fancying themselves as a venture capitalist, whether they were truly VCs or whether they were working in corporate venture arms, or, it just became the hot thing. Right. And then it suddenly became a not so hot place. Right. Like suddenly people realized, especially last year or so, wow, this business is really, really difficult. When times are more challenging, when capital is not as ubiquitous, when it's much more difficult to raise a follow-on round, that's more challenging. So what we saw happen last year or the last few years with Tiger, with SoftBank, we saw many more venture funds grow from smaller niche funds to multi-billion-dollar funds, putting a lot of capital out to work and doing more like a high-volume deal strategy and just raising larger and larger funds, right? Now, as the LP market, our investors, as they are a lot less bullish on the venture industry, as they don't have the same level of distributions as they did a few years ago, the pacing has changed. Now, before you can no longer assume that every year or two you will automatically have an up round and a new source of capital for that Series B or Series C. So what this means is it's really going back to what really the venture industry was for like the first 10 years of my career. I started in the venture industry a few years after the dot-com bubble burst, and then the financial recession happened. And I remember every time we raised a round, it was never a guarantee that a company would be able to raise a Series B or a Series C or Series D. You always were looking for optionality, either a path to profitability or a potential strategic exit if indeed a larger growth round didn't materialize. And these are all muscles that I think some of us who were from those eras are kind of rebuilding again. But I think the overall, what's happening now in terms of return to fundamentals, return to unit economics, as opposed to growth at all costs, is a healthy thing for the business overall. And now we'll see, kind of last thing I'll say is that where I think many people were trying to almost create a kind of a Walmartization of venture capital, like, okay, this could be something that's like any other financial product. A lot of people have realized suddenly now in the last few years, and they seem to do this every 10 years, that it's not that way. That venture is a craft business. It's not something that's like a high volume, AUM sort of game. And I think what now what we'll see is we'll always see the larger mega funds, the Andreessen Horowitzes, the Sequoias of the world. But I think you're going to see more focus placed in terms of who can generate alpha through proprietary domain expertise or proprietary networks in specific geographies, which is something that we focus on a lot at ASV.
And Anthony, what's your take on that?
Yeah, so I don't have quite as much experience as Somak, but I was watching an interview with Bill Gurley the other day, and he was talking about VC as an asset class and how it's such a long feedback cycle. And so there is the natural kind of peaks and valleys to this industry, even more so than a lot of others. And it's important to stay very measured throughout all of it. So just even at the highest heights of the market, you can't let yourself get carried too much away. But quite similarly, when things look, everything's over, it's doom and gloom, there usually is kind of a sunnier day around the corner. And so what he was talking about was when you looked at 2021, that wasn't a normal time. That represented a peak. And so that's when a great time to be in venture. That's when most of the returns are to be had. But you can't then just exit the market immediately thereafter. You have to continue to laying the groundwork, as Somak was talking about, and meeting with these founders and continue to cultivate relationships and a network for the next time that goes around. And, as he said in the interview, it doesn't necessarily mean that it's going to be in another 2 or 3 years, but those days will come back. And so it's really investing for the long haul. And so it's a constantly evolving industry, and it's really why I find it so enjoyable.
Cool. Well, let's talk about your investment thesis. What exactly is it, and what's your criteria for making an investment? Somak, what would you say there?
Sure. So we're generally focusing on high growth software businesses that are targeting large industries that are often in the early stages of software innovation, right? So when we look at the criteria that we look for, whether a company even presents to our team, we look at a core set of criteria that's probably common among many VCs, right? Is there a massive market? For us, we look at a bottom-up market size of at least $1 billion, but we love multi-billion-dollar type bottom-up market size opportunities. We look for exceptional management teams. Even a first-time founder may not have a lot of domain expertise, but does she or he have the passion and the conviction and the ability to attract talent, capital, customers, right? And do they have a strong technical co-founder? That's also very important for us. We don't back one woman, one man bands. We like to have people who have a nice blend of technical and business expertise. We then look for businesses that have strong unit economics. Now, in an earlier stage business without a lot of financial information, there's a bit more of guesswork and speculation when you have limited data. But because we've invested in software companies for a long time, we can make some basic operating assumptions there and then look at some feedback from existing customer prospects in our network. So unit economics. Competitive differentiators. Is there a moat through proprietary data, distribution, channel partners? That's another key thing that we focus on, right? And then this is to Anthony's earlier point about putting together a financing strategy that makes sense. We try to look clearly at what the company's trying to achieve. And as Anthony noted about the 18, 24-month runway, we work backwards and say, based upon what we know about this market, about this business, and our own experience in backing software companies, is that attainable? And if we feel a lot of those things check out, that's what gets us excited about going the next step and potentially investing.
Cool. And Anthony, can you talk about a startup that you may have funded that fit that thesis?
Yeah, of course. So the startup was the most recent one. We invested in May. It hasn't yet been announced, but it was a very exciting company in the B2B marketplace world. And it's creating a marketplace for heavy industrial equipment, the original equipment manufacturers, OEMs, to connect them with construction businesses, heavy machinery type businesses across the US. And so this was a really exciting company because they're actually, to some point of unit economics, upon the first transaction in that marketplace, it's already profitable. So it's not a company that is burning a lot of money, but it's actually profitable on each transaction because of their low customer acquisition cost. There's other interesting components of the company. There's a strong fintech component. So there's a lending capability with the financing arm, as well as they have a nationwide service technician network to help care for the machines that they sell throughout the country.
Sounds like a great deal. Looking forward to seeing it further. So let's talk about the challenges in the marketplace. So what do you think is the main challenge your startups face in today's market?
Yeah, I think there's a lot of challenges, right? I think there's opportunities, but there's challenges for sure too. The challenges are that it's, I said venture capital is not an easy profession. Entrepreneurship is not an easy profession. I think I think the challenges are right now is that there are certain people that are configured to take on the type of risk involved with startups, But I think there's, at times like when the economy slows down, in this case, the venture capital markets have slowed down a bit, there tends to be sometimes more of a shift of people going into more traditional corporate jobs. And so that part of it is like, getting access to certain types of talent is more difficult. The flip side is that the larger corporations are not as stable as people might have once expected them to be. So if you as a CEO can actually make the case that your company is well funded, has got good backers, has solid prospects for growth, and that there still is an opportunity to tap talent that you may not have actually been able to get a few years ago. I think I've already touched upon the fact that capital raising is a lot more challenging, right? And I think that's one of the reasons why when we're making any investment today, we always care deeply about making sure that we have strong syndicates. And I think we spend even more time now vetting our syndicate partners to make sure that they have a history of supporting their companies through thick and thin, because, everything in this business is not always up and to the right. And if you have people who are fair weather friends who might write that first check as an option and then ghost you after that first round, that's going to create a lot of problems for companies and put them in no man's land. And so I'd say those are some of the challenges that we see companies facing, but we work closely with their founders to try to mitigate those risks.
Right. And Anthony, what do you think of the challenges in this market for the investor side of the equation?
Yeah, so for the investors, I think some of the points could cross over to that as well. So for us, it's also finding a strong syndicate of co-investors for a given round. So just as Somak mentioned, we want like-minded investors that are in it for the long haul. And so for that, it's really kind of learning the reputation of these other potential co-investors as well, to make sure that we feel that we have enough like-minded people around the table to support the company for that next phase of growth. Or if there's a bit of a stumble, how could they use their own networks to help out as well? And I think that would be a pretty big one. So, Mac, is there anything you'd like to add on that point?
No, I think you covered it. I think that's fine. Mm-hmm.
Great. Well, you both see a lot of different businesses and new business models out there in today's market. If you could start a business tomorrow, what would that business be? Somak, what would you think is a great opportunity to start a business today in?
I'm going to answer this. This may not be the response you were initially expecting, but I actually always think about starting new businesses and incubating new businesses. I am at probably a different stage in my career, obviously, than I was when I was in my 20s. So thankfully, I don't have to think about making money the same way I did earlier in my career. I see a lot of parallels with venture capital in the hospitality industry. We've invested in multiple hospitality tech companies. Actually, one of our most successful exits was a company called Bento Box, which is a web and marketing automation platform for the restaurant industry. And so I think Anthony knows this. I've actually always had a real passion for cooking. I recently built a tandoori fire pit in my backyard, and because I really missed good Indian food after I left New York City. But I just think there's a lot of parallels between hospitality and venture capital, and among them, just a focus on devoting yourself to the craft, serving others, creating an incredible experience. If you talk to Danny Meyer or Jean-Georges and you look at how they look at their restaurants, every restaurant you go to, you get that same experience, that same interaction. And that's something that I've always tried to focus on in VC, is like every interaction someone has with Anthony or Nina or anyone else on my team, I want them to feel, even if we don't say yes, that was an awesome experience. And I see a lot of the same things in hospitality. And part of the reason I get excited about that is we live in a region now that's going through tremendous transformation, is going through a renaissance. Micron, the large chip company, is investing $100 billion in a region. And their goal is to create a region where people will want to move and live their place. In many ways, what you have in Austin, which has just been so inspirational to so many of us in other cities. Like you can't just have great tech companies. You have to have great food. You have to have great culture, great bars, a place where people want to congregate. And that's something that I'm very passionate about outside of venture capital.
Very good. And Anthony, what would you think is a great opportunity for starting a business today?
And I'd like to add, I've been prodding Somak to open that restaurant. So I think that'd be a nice addition to our town.
Anthony has a background. His family owns a restaurant too, so he knows something about it too.
Has experience there too. Good.
But somewhat related. So my dad, before he opened up his Italian restaurant in Syracuse, he had a trucking company, and they did a lot of long distance hauling, primarily down in the New York City metro area as well as in parts of Canada. And so growing up, I would always help him wash the trucks or walk around the lot. And I always thought that was a really cool industry. And so if I were to start a company today, I don't think I would necessarily start a trucking company. There's a lot of logistical hurdles with that. But if I could find a way to marry my interest that I would do day to day with venture capital and looking and evaluating very cool software companies along with kind of that family history in the trucking space, I think that'd be a really cool opportunity to marry those two interests, but still looking for that right idea.
That's quite interesting. Yeah. Well, in the last minutes that we have here, what else should we cover that we haven't? Somak, what would you like to add?
Yeah, I think that what I would say is, I know we've talked a bit about how challenging the markets are today compared to, say, a year or 2 years ago, right? But I think that, in general, to be an entrepreneur VC, you have to be an optimist. And we can't forget about that part of our business, that we have to be optimistic. And one of the things that has been so illuminating for me in my career is that there's all these people who are naysayers. I'll tell you as an entrepreneur, no, no, no. We hear a lot of that too, by the way. For the entrepreneurs in the audience, like we get our ass kicked a lot too, especially in this environment where, but the reality is that for all the people who say no, you might start thinking, you might start having self-doubt, right? But you have to also think about, what are all the things that can go right? That's what's important in whether it's entrepreneurship and VC. Most things could fail, but if it's right and it's transformative, it can be life-changing. And that's something that we think a lot about. Asymmetric bets on the upside, what can go right versus getting bogged down in the doom and gloom.
And Anthony, your take.
Yeah, no, I agree with everything Somak said. I think something else that I would mention, we talked a little bit about it earlier in the call, but Armory is focused on secondary markets. So we spend pretty much the majority or nearly all of our time in different secondary markets across the U.S. It's been primarily upstate New York and increasingly looking at some areas of the Midwest. So whether that's Indianapolis, where one of our partners, Nina, is based, or in Pittsburgh, where I think I've been 3 or 4 or 5 times this year alone, Columbus, Ohio, and some other areas in those states. It's really been really interesting for me to see these companies, really innovative companies, get brought up in areas where you wouldn't necessarily be thinking about. And Somak had mentioned Micron coming to Syracuse, which is, I think, the largest private investment ever in the United States, potentially being $100 billion. But there's these other kind of major projects happening. For example, Intel is building a plant outside of Columbus. There's one plant getting built outside of Indianapolis. And so with all these capital investments that are being made in these areas, I think the future looks incredibly bright, that we continue to see these really great tradition of innovative companies being born in areas that people might not initially think of, but there's a lot of stuff happening there nonetheless.
Good. Well, Somak, how best for listeners to get back in touch with you?
Sure. I think the best way to reach out to us would be through our emails or just our first name at armorysv.com. Anthony often takes a first pass at reviewing companies that might be fit, but we're always accessible. You can also follow us at our Twitter. I guess I should know my threads handle now too. My Twitter handle is SomakC. Anthony, what's your Twitter handle?
I was gonna say I'm not the best with Twitter. I have to get better. So email's definitely the best for me, but it's Santaro_Anthony for Twitter. Something I need to work on.
Well, great. Well, I want to thank you guys for joining us today. We'll put your contact details in the show notes. We appreciate the great advice and insight you provided today. And with that, we'll let the listeners get back in touch with you afterwards, and wish you guys a great day. Thanks so much for joining us.
Thank you so much, Hall. It was a pleasure. Really enjoyed our conversation.
Thank you, Hall. Appreciate it a lot.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.